If you bought a brand new car, truck, or SUV after December 31st, 2024, you have access to a specific tax deduction that could save you serious money on your upcoming return. Under the new tax rules, eligible taxpayers can legally deduct up to $10,000 of the interest paid on their vehicle loan directly from their federal taxable income. The best part of this provision is how universally it applies. You do not need to itemize to claim this money. This deduction sits perfectly on top of your return, whether you choose the standard deduction or prefer to itemize. Officially, the IRS calls this the Qualified Passenger Vehicle Loan Interest Deduction. It was established under the One Big Beautiful Bill in July 2025, and the Treasury Department just finalized the official guidance for taxpayers. To get this applied to your return correctly, we are going to walk through 3 specific steps. First, we will verify your vehicle qualifies. Second, we will calculate your income limits. And third, I will show you exactly how to fill out the new IRS form to claim it. Average vehicle loan rates currently hover around 7%, meaning you are likely paying hundreds of dollars a month just in interest. Successfully capturing this temporary deduction allows you to keep hundreds or even thousands of those dollars in your own pocket. The IRS outlines 5 strict rules your purchase must meet. Rule 1. The vehicle must be completely new. Rule 2. You must use it for personal driving more than 50% of the time. Rule 3. It must be financed with a secured loan. And Rule 4. That loan must have originated after December 31st, 2024. The 5th rule is the most rigid requirement. The vehicle's final assembly must have been completed inside the United States. You verify this using your vehicle identification number, or VIN. You can find this 17-character code printed on your lower dashboard or your registration card. Once you have your VIN, go to the National Highway Traffic Safety Administration website at nhtsa.gov/VIN-decoder and run it through their search tool. Scroll down to the field labeled Plant Country. If it reads United States, your vehicle clears the final hurdle. This 60-second database check is the absolute non-negotiable prerequisite. Without confirming U.S. assembly, you cannot legally claim any part of the $10,000 deduction. Next, we have to look at your Modified Adjusted Gross Income, or MAGI. This is your total income before certain deductions are taken out, and the IRS uses it to dictate your exact maximum allowable deduction. This chart shows the exact income brackets where the deduction phases out. For single filers, the deduction begins to reduce at a MAGI of $100,000, disappearing entirely at $150,000. For married filing jointly, the phase-out starts at $200,000 and drops to zero at $250,000. If you file your taxes as married filing separately, the IRS legally excludes you from this deduction entirely. Let's calculate how the phase-out works using a single filer named Marcus. He has a MAGI of $115,000. This means he is $15,000 over the limit. In 2025, he paid $3,200 in qualifying car loan interest. The IRS reduces your maximum deduction by $200 for every $1,000 you are over the limit. Marcus has 15 blocks of 1,000. 15 multiplied by 200 equals a $3,000 reduction. His maximum allowable ceiling drops from $10,000 to $7,000. Because his actual interest payment fits beneath his adjusted ceiling, he deducts every penny. At his tax bracket, that single calculation securely saves him exactly $704 in federal income tax. Step 3 is executing the paperwork. You need the exact amount of interest you paid in 2025. Your lender was required to generate this statement for you, so log into your auto loan portal or check your physical mail to retrieve it. You will carry that number over to a brand new tax form called Schedule 1A. Specifically, you want to navigate down to Part 4, which is explicitly titled No Tax on Car Loan Interest. The form requires 3 inputs. On line 1, you will enter your 17-character VIN. On line 2, input the total interest you paid from your lender statement. And on line 3, you enter the maximum allowable deduction you found after calculating your income phase-out. To finalize the process, the total at the bottom of Schedule 1A must be manually transferred to your main Form 1040, specifically onto line 13B. Correctly routing your data through Schedule 1A and onto the 1040 is the required mechanical step to force your tax software and the IRS to officially register your deduction and lower your tax bill. Before you file, watch out for 3 common disqualification errors. Mistake 1 is assuming an American brand guarantees U.S. assembly. Many domestic brands manufacture models across the border, and many Japanese and European brands manufacture vehicles right here in the US. Always check the VIN. This breakdown illustrates mistake 2, deducting negative equity. If you rolled an outstanding balance from an old vehicle into your new car purchase, the interest generated by that old debt cannot legally be deducted. You must ask your lender to separate the two amounts. Mistake 3 is attempting to claim a lease. The IRS explicitly excludes leased vehicles. You must hold a traditional, secured auto loan. Here is your final checklist. 1. Run your VIN through the NHTSA decoder. 2. Pull your 2025 total interest statement from your lender. 3. Verify your tax software successfully generated Schedule 1A. While this legislation applies to tens of millions of active auto loans, the taxpayers who take a few minutes to actively track down their VIN and lender data are the only ones who will actually capture the refund. If you found this helpful, hit subscribe. In our next tutorial, I will walk you through exactly how to set up your free IRS online account so you can track your refund status and access your tax transcripts directly from the source. As always, this video is for educational purposes only. Please consult a qualified CPA or tax professional regarding your financial situation. See you soon.